Throughout history, the 2008 financial crisis was one of the most devastating global economic events of the 21st century, leaving a lasting impact on economies, financial systems, and ordinary people across the world. Often referred to as the global financial crisis, it was triggered by the collapse of the U.S. housing market, but its roots stretched much deeper into years of financial mismanagement, risky lending, and weak regulatory oversight. This crisis was not limited to one country or one sector. It spread like wildfire across international markets, shaking both developed and developing economies. Banks collapsed, businesses shut down, unemployment skyrocketed, and millions of families lost their homes, jobs, and savings. What made the crisis particularly alarming was that it exposed the fragility of financial institutions that were considered too big to fail. The purpose of this script is to explore the multiple causes that led to the crisis, examine the devastating global impacts, discuss how governments responded, and highlight the lessons that can be learned to prevent future economic disasters. By understanding this moment in history, we can better prepare for the future and avoid repeating the mistakes that created such widespread suffering. The causes of the 2008 financial crisis were complex, but at the center of it all was the housing market bubble in the United States. For years, banks and lending institutions were aggressively providing mortgages to borrowers who lacked the ability to pay them back. These loans were called subprime mortgages, and they were given to individuals with poor credit histories or low incomes. Banks were motivated by short-term profits and relied on the false belief that housing prices would always increase. As a result, they approved millions of risky loans without properly checking if borrowers could repay them. These loans were then packaged together into financial products called mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, which were sold to investors around the world. Rating agencies, whose job was to assess risk, often gave these products top ratings, even though they were built on shaky foundations. When homeowners began defaulting on their mortgages, the entire system started to collapse. Housing prices fell dramatically, leaving millions of homeowners with mortgages worth more than the value of their homes. This triggered a chain reaction of foreclosures, bankruptcies, and financial panic. Another major factor was the lack of government regulation, which allowed banks and Wall Street firms to engage in reckless behavior without oversight. In short, the crisis was caused by a dangerous mix of greed, risky financial practices, and weak regulatory systems. Although the crisis began in the United States, its effects quickly spread across the globe because of how interconnected the financial system had become. Many international banks and investors had purchased American mortgage-backed securities, believing them to be safe and profitable. When the value of these securities collapsed, it created a ripple effect that reached Europe, Asia, and beyond. Major financial institutions such as Lehman Brothers, which had survived for over 150 years, went bankrupt, while others like AIG and Citigroup required massive government bailouts to avoid total collapse. The stock markets around the world fell to historic lows, wiping out trillions of dollars in wealth. Businesses, especially small and medium-sized enterprises, faced difficulties accessing credit as banks tightened lending. This led to widespread closures and layoffs, pushing unemployment rates to their highest levels in decades. In the United States alone, unemployment rose above 10%, and similar trends were seen in countries such as Spain, Greece, and Ireland. Millions of people lost their homes to foreclosure, creating a social crisis alongside the financial one. Families that had saved for years saw their investments vanish, while pension funds lost significant value, threatening the financial security of retirees. The crisis not only damaged economies but also destroyed trust in financial institutions, raising deep questions about fairness, accountability, and the ethics of modern banking practices. To prevent the collapse of the entire global economy, governments and central banks around the world intervened with emergency measures. In the United States, the government introduced the Troubled Asset Relief Program, TARP, which provided hundreds of billions of dollars to stabilize banks and large corporations. The Federal Reserve lowered interest rates to near zero, making borrowing cheaper, and introduced a strategy known as quantitative easing, which involved injecting large amounts of money into the economy to restore confidence and encourage lending. Similarly, European nations and other countries adopted bailout packages and stimulus programs to prevent their economies from falling into deeper recessions. While these measures prevented a complete collapse, they also sparked debate. Many critics argued that the bailouts rewarded the very banks and corporations whose risky behavior had caused the crisis in the first place, while ordinary people bore the brunt of the suffering. Millions of homeowners were left without support as their homes were foreclosed, and workers lost jobs with little compensation. At the same time, government debt increased significantly because of the rescue packages, leading to long-term consequences for public spending. Despite the criticism, these interventions played a crucial role in gradually stabilizing the global economy, although the recovery process took years and left lasting scars on societies around the world. The 2008 financial crisis provided the world with painful but valuable lessons about the dangers of unchecked financial practices and the importance of strong regulations. One of the key lessons was that financial markets cannot be left entirely to regulate themselves, as greed and short-term profit motives often overshadow responsibility and long-term stability. The crisis revealed the risks of complex financial products like MBS and CDOS, which even experienced investors did not fully understand. It also showed the consequences of weak oversight, as regulators failed to notice warning signs until it was too late. In response, reforms such as the Dodd-Frank Wall Street Reform and Consumer Protection Act were introduced in the United States to increase transparency, protect consumers, and hold financial institutions accountable. Globally, countries tightened banking regulations and required banks to hold larger reserves to prevent future collapses. However, many economists argue that financial systems remain vulnerable, and new risks such as digital currencies and global debt continue to pose challenges. Ultimately, the 2008 financial crisis serves as a reminder that economic stability is fragile and that governments, businesses, and individuals must act responsibly. By remembering the suffering it caused and learning from its mistakes, the world can work toward building a financial system that is fairer, safer, and more sustainable for future generations. The 2008 financial crisis was more than just an economic downturn. It was a turning point in modern history that exposed the weaknesses of a system built on unchecked ambition and short-term gains. Millions of lives were disrupted, and the world learned a painful lesson about the cost of ignoring warning signs in the pursuit of profit. What makes the crisis particularly important is that it was not caused by a natural disaster or an unavoidable tragedy, but by human decisions. Decisions made by bankers, investors, regulators, and governments who underestimated the dangers of their actions. This fact alone makes it clear that the responsibility for preventing future crises lies firmly in human hands. The legacy of 2008 goes beyond financial losses. It reshaped public trust, widened the gap between the wealthy and the poor, and fueled political and social debates about fairness, justice, and the role of government in protecting citizens. For many families, the crisis was not a story of numbers and stock markets, but a deeply personal tragedy, losing a job, a home, or years of savings. These stories serve as reminders that behind every economic chart or policy decision, there are real human lives affected. The aftermath of these emergency measures brought about significant transformations in both economic policy and public perception. While the immediate goal of averting a total financial meltdown was achieved, the longer-term effects rippled across societies in complex ways. Governments and central banks had effectively rewritten the rules of economic engagement, embracing large-scale intervention and unprecedented liquidity injections. These actions helped stabilize financial markets and restore some level of trust in the global economy, but they also deepened economic inequalities and stirred widespread political discontent. Ordinary citizens, especially those in the working and middle classes, increasingly questioned why public resources were mobilized so swiftly to rescue corporations, while individuals facing eviction, unemployment, and bankruptcy received minimal support. As the world's economy continues to change with new developments such as digital banking, cryptocurrencies, and rising global debt, the lessons from the 2008 financial crisis remain just as important today. The truth is that financial systems will always carry risks, but these risks can be reduced when there are strong regulations, greater transparency, and ethical behavior from financial institutions. The most important lesson is the need for balance. A balance between making profits and taking responsibility, between innovation and safety, and between freedom and accountability. The crisis of 2008 served as a powerful warning that stability is fragile and must be carefully protected. Its impact still reminds us that if we fail to act responsibly, the world can once again face the same kind of economic disaster. If you found this explanation helpful, make sure to subscribe for more deep dives into history and economics.